Hello and welcome to RiskScout's webinar, CEO Ask Me Anything, Managing Risk in Uncertain Times. We're excited you're here. Before we dive into the content, let's run through some quick housekeeping items. RiskScout will be sharing all of the webinar resources, including slides, handouts, and the recording in a follow-up email, so keep an eye on your inbox. We also want these sessions to be as valuable for you as possible, so we encourage you to ask any questions you have throughout the session in the question section of the webinar panel on the right side of your screen. We will run a few polls throughout the webinar to help you engage with our speakers, so participation is greatly appreciated. For those of you joining us for the first time, RiskScout is a team of former bankers, regulators, and industry experts that have joined together to help community financial institutions unlocks complex markets to increase deposits from their own backyard. Through both software and services, RiskScout reduces the time, effort, and uncertainty around expanding into new markets so you can increase your footprint without opening new branches. If you're interested in learning more, visit RiskScout.com and get in touch. Next month, RiskScout will be hosting its second ever advisory workshop where our team of experts, myself included, will spend 90 minutes working through hands-on exercises to help financial institutions that have or are interested in starting a cannabis banking program. All of our attendees will receive their own cannabis policy template, a cannabis-focused risk assessment, and an ROI calculator to determine how much business your program needs to be profitable. Whether you have a new program or one that's been running for years, this session will help you clear the smoke around serving cannabis-related businesses. Visit RiskScout.com to reserve your seat. Later next month, RiskScout is partnering with Quantivate again for our discussion around cryptocurrencies and everything you need to know to serve the 20% of Americans that own them. Attendees will learn not just trends and backgrounds on the market, but will also discuss best practices, risk mitigation, and revenue opportunities surrounding crypto. This free session is also eligible for 1 hour of continuing professional education credits, so it's certainly one you won't want to miss, so sign up today. Without further ado, let's dive into today's content. I'm Kristen Parker, RiskScout's VP of Compliance and Operations, and I will be moderating today's session. Prior to joining RiskScout, I spent 20 plus years in banking with a focus on BSA AML efforts as a BSA officer. If it's happened in BSA, I've seen it. I'm here today to help guide the conversation between Justin Fischer, CEO of RiskScout, and Andy Vanderhoff, CEO of Quantivate. Justin, would you like to take a moment to introduce yourself and tell us a bit more about RiskScout?
Sure. I come here via video. Thank you all for joining today. Excited to get a chance to talk. So Justin Fischer, I'm CEO, co-founder of RiskScout. We are based in Austin, Texas, half of us, the rest are across the country. And I spent about 21 years building software for banks and credit unions. Everything. I've done hundreds of core conversions, lots of digital banking. And so, the last 4 years or so, I've been pretty deep in compliance. I am also, I didn't put it on the list here, but I'm also CAM certified. And I really appreciate the time I get to spend with both examiners, regulators, and the BSA officers we work with on a daily basis at RiskScout.
Perfect. You forgot to add that you've also slept at a Holiday Inn Express before.
I have that, so I can talk about some compliance stuff, right?
Thanks for that introduction. Andy, would you like to take a moment to do the same?
Absolutely. Hello, everybody. My name is Andy Vanderhoff. I'm CEO of Quantivate. Quantivate's a governance, risk, and compliance company that serves primarily banks and credit unions in the U.S. Started the company almost 18 years ago. Before beginning Quantivate, I worked at a really large bank called Washington Mutual, and got to watch that journey occur. I'm sure we'll be talking more about that in a little bit. But I'm joining you from the very toasty Phoenix Valley. So in the Phoenix Valley, there's a few months of the year where the weather is literally trying to kill you, and that's right now. So it's I know some of you in Texas might be complaining it's hot, but we're used to it here in Arizona. So anyways, looking forward to the discussion.
Great. Well, I appreciate that. So now that we've all gotten to know each other, let's move away from the slides and let's just dive right into the questions. In today's conversation, will be broken out into three main parts: the economy, recent bank collapses, and how to prepare for the future. And while I know we're all eager to dive into these, I think the most important thing we need to start with is, why should we trust you guys in what you're saying? There's a lot of CEO stuff that's out there that is a lot of fluff, if we're just going to put it frank. So why should our audience trust your experience and advice when it comes to risk management? And I'll start with you, Justin.
Right. Well, first, most importantly, I have a guitar right on my wall, so that's for something, right? Not to call you out. But no, I think you know, like I do have a lot of experience in the space. I follow a lot of the trends, especially in progressive banking. But I think it's really healthy for you to go and do a lot of your own research and synthesize things. I hope what we can provide you today is some of our insights and some of our opinions. No one has a crystal ball, but I have spent a lot of time in the trenches, both in bank technology and economic factors. I will also say in the last 2 years, pretty heavy time in the venture capital market. I was on a private equity side before RiskScout, and then in the VC market in the last couple of years. So I have some insight into there that I think a lot of people don't generally have. So hopefully give you some good opinions, and you can take it and build off of that and do your research.
What about you, Andy? What you got for us?
Yeah, thanks. Well, my background and experience, and one of the reasons I started Quantivate is I worked up until 2005 at the biggest bank ever to fail in the history of banking in the United States. That's Washington Mutual. Even if you don't adjust it for inflation, it's still bigger than Silicon Valley Bank. So that just gives you an idea of how bad the 2008 financial crisis was. So having bootstrapped my company in 2005, working through trying to sell the financial decisions in 2008, I got a lot of firsthand experience of what it's like to both try to grow a business, serve customers in the financial industry through economic uncertainty. And make no mistake, we have a lot of economic uncertainty in front of us. We haven't come to the end of this. I think it's just the beginning. Great institutions take risks seriously, and they manage those risks appropriately. And I think that those who survive and thrive during this time are going to be the institutions that do just that. So excited to share some of my opinions and background. I've got some war scars, I should say, probably more like on the back of my head where there's missing hair. I sort of have a hairdo for Zoom, I should say. It's good in the front and pretty ugly in the back. But anyways, having pulled a lot of my hair out, going through some of this stuff myself, hopefully you can save some pain for other people and not having to do that also.
Yeah, so you're saying you don't want me to ask you to do a 360?
Well, you know what I mean. Yeah, no dancing.
Yeah, I'm in charge. So I think we should start with a poll. Polls are always a good way to start the conversation. So why don't we go, Ethan, turn it over to you and go with the economy poll.
Excellent. So that will bring us to our first poll question of the day, and that asks the question, where do you expect interest rates to be a year from now? This should pop up on your screen now, and you could select one of the 5 answers, ranging all the way from significantly lower interest rates to significantly higher interest rates. If you wouldn't mind taking a quick moment and giving us your answer so we can show this off to our panelists today and see how it stacks up to what they have seen and heard in the market themselves. We'll give you all just a couple more seconds to get these responses in. Perfect. Okay, and we'll share out these results. So it looks like we had nobody that believes that our answers or our interest rates will be either significantly lower or significantly higher. 27% think it will be slightly lower or the same, and the majority of our audience responded that they will be slightly higher interest rates 1 year from today. I'm curious, Justin, how does that stack up to what you've seen in the market?
Yeah, I mean, look, I mean, there's still a lot of uncertainty, and so I don't think we're completely out of the woods on sort of whiplash from the pandemic, including inflation. And you know, the Fed's obviously signaled every time inflation is continuing to rise, they're going to continue to raise rates. So yeah, I mean, I think there's a lot of like, you know, cautious, you know, pessimism, I guess, maybe, you know, it's not optimism around the fact that it'll either stay the same or it will kind of be at a straight line, or we may see even an increase there. And yeah, I don't disagree with that.
Andy, anything to add there?
No, I concur, slightly higher. The reason why we're raising rates obviously is to control inflation, which, the government caused by pumping a whole bunch of money in the economy. So you look at that, they haven't really stopped pumping that much money in, and so they're trying to, kill the economic output to help pause that. So I still think we got ways to go to get it under control. And so we got to be ready to manage that in the financial world because it's still going to be some challenges coming up.
Okay, so on that note, let's start with our first question. Are we in a recession? And if we aren't currently, are we headed for one in the next year?
Yeah, you want me to go on that one? I'll take that one.
Throw it out.
Sure. I think, the definition is 2 consecutive quarters of having negative economic growth. Last quarter we grew. They might revise that at some point, but it still looks like we grew. This quarter, most of the analysts are saying we grew again. Not sure if that's going to hold water. But again, so I wouldn't say we're in a recession. Are we headed for one? I'm not sure how you're going to get inflation under control without heading to a recession. So my pessimism gut tells me that, yeah, we're going to be there. I mean, if you look at it, 2008, last major financial crisis, you could call COVID a financial crisis, sort of, but I mean, it recovered so quickly. We didn't really see what we typically find in a boom and bust cycle. At a minimum, we're certainly in what I would call a rolling recession right now. So certain sectors of the economy are getting hit. You're seeing that clearly hit housing prices. Those are going to continue to decline, and construction is next. Is it going to affect manufacturing? I think that's the core here, that there's a ton of manufacturing jobs getting created. And I don't think it is, because there's so much government investment going into electric vehicle manufacturing that they're going to prop that up. But again, the problem with that is you artificially put money in the economy, you're causing more inflation. You cause more inflation, you cause higher interest rates. So how do you gauge that? Well, again, I think higher interest rates and recession are coming. Justin?
Yeah, I mean, that's well said. I mean, I think we're teetering, right? We're kind of Indiana Jones on the narrow balance beam here. I think, the big factors that are keeping us on the beam: labor market strong, travel, consumer spend is strong. I mean, have you been to the airport this summer? It's crazy. Like it's way back, to where it was prior to the pandemic. But at the same time, consumer debt's very high, right? And we're kicking back in on a number of student loans. I worked in a student loan market for a while, and I saw what a lot of Americans have in student loan debt. And I mean, they're paying, they're making, somewhere between $4,000 to $6,000 of income a month, and they're paying $1,200 to $1,500 a month in payments. If those have been on pause for 2 to 3 years and then they come back, I don't know that people have really prepared for that. So I think there's a combination of things. If the labor market starts to really be impacted, then spend drops, debt can kick in here and people lose quite a bit. And then student loans, I think, are going to affect a lot of the population in terms of their ability to now factor in a new $1,200 loan, right? So that could kick in a potential recession. And we can talk about it kind of through today, but I mean, there's some other bigger whammies, if you will, bigger factors, such as the commercial real estate situation, fraud, that could also impact the potential. So I think we're kind of precariously on the ledge, right? And we could pull out of those things, but I think we're still dealing with essentially the pains of whiplash from the pandemic. And so it could at any time be one of these other factors that tips us over.
So we're finding ourselves in that really unique economy. So how do FIs really better prepare for those increasing unknowns?
I could jump in initially. I think couple of factors that came out of the pandemic, because I mean, we'll say a lot about the pandemic. It really created this sort of the wake that we're dealing with now, if you will. First and foremost, I don't know if you saw the numbers, but prior to the pandemic, on the credit union side, I know we have a few credit unions on the call, there was actually a branch decrease. This is something that we've known for a long time. I worked for Q2, did a lot of digital banking. We pitched, that more people want to move to digital. But I've literally had my institutions tell me, hey, we taught people for 2 or 3 years how to do things electronically and not come into the branch. We talk about the same thing around return to office, but they don't want to come. So they want to do more convenient things. So I think one of the biggest things I've seen is institutions doubling down on digital solutions. not just talking about Quantivate and RiskScout, but really digital front end. So how do I open accounts? How do I, get service on my accounts? And then if their institution can't provide those, looking at fintech alternatives, looking for that convenience and looking for those tools in that way. And then, like I said, I think kind of reducing the overall branch building. And the last thing I'll say about branches is I have a bank here in Austin, and they were trying to acquire a branch, and their core provider told them it was going to take 12 to 18 months to even do the work. So even with that branch acquisition, which is the way a lot of institutions will grow, that wasn't even on the table if they couldn't get their core to complete the work. I used to do those all the time at Q2. You have to do them quickly to make it relevant to what the institution needs to do. So digital first, I think is really growing. Maybe some of these alternative markets, but and also kind of reduction in branch.
Yeah, Andy?
Yeah, I think you got to really take a good hard look at your risk management practices. That's going to be very important. If the interest rates continue to go up, all right, how is your institution going to interact and react? Are you going to continue to invest in, 10-year treasury bonds, knowing interest rates are going to go up? You should think about that, right? Where are you going to put the deposits if treasury bonds aren't a great place to invest them? Good question. So your model and what you're doing with your deposits really matters a lot more than it used to, primarily because speed of information travels so quickly, and things can really go sideways very, very fast when people get a little nervous or weirded out about what your financial stability of your institution is. So risk management, very, very important. Looking at the potential types of risks that could affect you. You mentioned commercial real estate. How much of your portfolio is commercial real estate? Do you have enough assets on hand to cover those liabilities? Have you set aside enough loan losses? I understand that setting that aside means you have less capital to potentially invest. But at the other hand, if you don't have enough to cover, it's going to be really challenging. And we all know that the feds have their own version of reality, but I think you've got to have a very strong opinion internally with a risk culture that manages that and manages it appropriately to not only meet your goals, but also keep your institution safe and sound for your customers.
Yeah, and I think it's good to add there that it's one thing to talk the talk, but to walk the walk is totally different, right? So the proof is in the pudding for sure in that regards. So Justin, in particular, I got a question that came for you. As funding from venture capital firms dry up, an increasing number of fintechs are beginning to suffer and even fail without necessary cash flow. How do you foresee this impacting community financial institutions?
That's a great question. There's really kind of a bifurcated answer. So there's like in communities like Austin, for example, and there's quite a few of these across the country, where technology companies, right? And I'm not just talking about a company that uses a little bit of technology, but technology-driven companies that earn revenue through technology, which we could call fintech. That's a pretty broad term, but they are a big part of the local financial institutions market, right? And so I think there's a normal sort of survival of the fittest going on with this kind of thing, because I think if you ask the VCs, they'll say the companies have had a heyday for the last 5 or 6 years of evaluations and funding. But I also personally am being part of the fundraising process, and fortunate we closed. But a lot of people who are nice, strong revenue companies and products couldn't get anything better than a 50% decrease in valuation. And if you have something like that happen, sometimes that makes your company insolvable, right? Even if you have cash on your balance sheet, you can't continue to run the company with 50% less equity, essentially. And so we've seen this problem. Now, I will say VCs are investing. They're just cherry picking, right? And it takes a lot to get to that point. And then some of these VCs haven't even, they'll still talk to you, but they haven't raised their full funds. So, or have the funds to deliver. So they're just really wasting your time. And so it really matters on that side in terms of being traditional companies. But then I'll say we work a lot with banks that do something called banking as a service. So, and we're doing a webinar next month on this as well. If you are sponsoring or thinking about sponsoring a technology company that's offering banking services, loans, deposits, business services, you got to really do your due diligence. You got to really look in and see, have they raised their money? Do they have line of sight on that money? Because chances are, and I've had this conversation with bank CFOs all the time, you're not going to necessarily be a super profitable company, in your early stages, right? But, and your funding can only last you so long. So it's really having that line of sight of that. And so if you are a sponsor institution, you really need to check, not just your fourth party due diligence, the people and businesses that they're boarding, but actually the fintech themselves. Like, are they, financially sound? Are they capable of making cuts when the time comes, right? A lot of people like to, hire a lot of people and have a lot of scooters, and that doesn't necessarily work well when you run out of money, right? So those are the two ways I think you got to keep an eye on this space.
What about you, Andy?
Yeah, well, one of the big discipline for every institution is third-party risk management and vendor management, part of a great governance risk compliance program that you should be doing. Everybody does it. Obviously, you get examined on it all the time. But one of the questions I always ask, third-party risk managers, and sometimes they ask their CFOs, is like, if you wouldn't lend vendor money, like, would you actually, or should you actually be doing business with them? Interesting question, right? So coming in and asking them for full disclosure of their financials, very important, very critical, and it's going to be something that's going to continue on, that you may not be able to do business because that's with organizations who simply won't share their financials. So it is something that you're going to have to push hard on, because it's a trust but verify type situation now for anybody. It doesn't matter what they say, it matters if you can verify what they say, right? And getting financials, getting audited financials, looking at those types of information is going to be extremely critical to choosing the right type of partners for your future institution.
Yeah, absolutely. Whew, man, that's a lot. I think we should move on to something sunnier, like bank collapses. So, Ethan, you want to hook us up with a poll?
Absolutely, I do. Y'all will see our second poll coming up on the screen here. This is asking, are we done seeing bank failures this year? Had a couple at the beginning, and we still got a good 6 months before the end of the year here. So y'all give us your opinion on one of the three answers. Yes, those were outliers. No, there will be a few more. Or no, this is just the beginning. Give y'all a couple more seconds to get your responses in here, where we hear from our experts on what they think. Excellent, y'all are quick on the draw today. Thank you for all of that input and feedback. Let's go ahead and share those results out. Seems like no one is too pessimistic. No one says this is just the beginning, 0%. That makes me feel a little bit better for sure. But we did have the majority of our audience saying there will be a few more, only 22% saying that those were just outliers. Andy, I'm curious, you've experienced some bank failures, as you said, firsthand. What do you think?
Yeah, there's going to be a few more. I think the majority say that. I concur with the majority here. Like I always, so I say the good news is, but it's been 8 weeks since a bank failure. The bad news is there's only been 8 weeks since a bank failure, right? So you look at that and you're thinking, boy, and you can kind of see the ones somewhat at risk when they talk about the assets on their balance sheet that they own, but those assets are underwater and they don't have to call them as underwater until they actually sell them. And so when this occur and then some of that information becomes public, that's a challenge. Even though I know that the Fed Reserve just said like the 50 biggest just passed the stress test. I think yesterday they're trying to calm the system. I think that there are a number of organizations out there below that 50 who might even pass a quote unquote stress test on paper, but once the nervousness gets out there and it gets on social media, they can see their deposits crash real quick and have a problem. So that's going to be something to keep an eye on.
Yeah, and I'll add to that look, just the recent data from the FDIC, what was it, just last week or so? The Q1 numbers were $420 billion deposits left, were exited out of accounts. Now, I'd really like to see the contrary to that, what was redeposited, but the primary reason was the issue with uninsured, overages and deposits, right? And I think that's interesting because, I talk to most of my community banks and credit unions, and they all have, CDARs and other options to move money around, but I don't think they communicated really strongly to their client base that was a possibility, right? And so, and their financial strength. But I I don't know if you guys, I don't know, Andy, with Washington Mutual, but I, in the early days of being a provider for banks, so '01 and '07, I was in companies doing this. And in '01, we literally had many Friday calls, right, where FDIC calls us. They give us the rundown. They used to do speakerphone calls for you guys that don't know this, and we would listen to them, what they call a raid. It wasn't a raid like a DEA raid, but they would go into an institution on Friday afternoon, fire every one of the chief executive officers, chief officers there, and then they would go in and reset the bank name. So they had already negotiated the transfer. So there were a lot of failures throughout the last couple of decades, but a lot of people didn't see them, right? And I think that's an important part of what Andy was saying is as it gets in the news and there gets to be, these organizations and these groups that drive panic, which mostly was VCs in the last one with SVB. But I think you're going to see more. But what I think you're going to also have more that you're not going to see, right? I think you're going to see what you want to call it, FDIC force or FDIC, transitioned institutions. And I think one of the biggest cause of that outside of unrealized losses is the commercial real estate situation, right? In situations where, or just say commercial loans in general, where they're unable to refinance those. And at that point, then your commercial businesses start to have some issues. And a lot of community financial institutions, I know that's their primary business, right? It's great. They loan Main Street businesses, loans when Chase and JP won't, or Chase and Bank of America won't, but it's a concentration potentially, right? And if they can't refinance those, that creates additional issues. So I think we're going to see more. We're going to have more that we don't see. And so, yeah, it's not the beginning of a big fallout, but I do think you're gonna, and just the last thing I'll say about it, we've seen consolidation for the past 15 years. So that's nothing new. I mean, banks have been buying smaller banks and, converting them over, but I think the reasons that they're doing it, right? The smaller banks would be in a situation where maybe growth isn't as high. And, I talked to a lot of CEOs, 200 million, 300 million, $400 million institutions who just tapped out their local market. So, really the only sort of viable thing is in terms of liquefying or capitalizing on your successes to sell that institution at that point. Anyways, that's kind of the thinking I see with that.
No, I remember Washington Mutual, Justin. There was about 2004. We went to like an all hands employee meeting, and Kerry Killen, the CEO at that time, he talked to everybody. And, he's bragging and says because they have like almost 75 years of acquisitions, 200 acquisitions, growth like crazy as an institution. And he said, the only thing that can hurt a bank is bad loans. Well, so it turns out it can actually, and that's what hurt him. So it's really fascinating how that whole thing works. But similar, action there. That institution got overhead of their skis, and when they put bad loans with good loans, put them together, sold on Wall Street, and then all of a sudden had to buy those back when things went down. They didn't have the capital to be able to do it. So clearly the risk management they missed there was what happens when interest rates go up and defaults go up as well. So if commercial lending has a similar type, right, I don't think it's going to start in residential at this point in time in consumer, but the commercial lending, that's a big thing. It's driven, of course, by the pandemic. We had an office, we closed it. We're all virtual now. I don't know where you guys are at, Justin, but there's so many companies that have done that, and all of those leases are coming due. And if it goes empty, and then you've got all the commercial real estate, what are you going to do with it? So huge question, huge opportunity for the right entrepreneurial spirit minded people. But again, big issue going forward.
Yeah, I'd like to add one last thing there is there was just a post of this recently. What was it? Maybe Fortune magazine. They were just calling it office utilization rate, right? And we were seeing prior to the pandemic down to 75% of office workers were utilizing an office. It is now down to 50%. And I don't know if you saw the news around like places like San Francisco downtown and other places that used to be vibrant downtown areas that have had major retailers and major office companies pulling out. But the retailers were one of the first signs. A Nordstrom's as an example, huge retailer spending a huge expense down in the Bay Area. They don't have any traffic during the week, right? So they've pulled out, closed down. And so I think that's going to have a ripple effect. I don't know, the article said something like 30 to 45%, commercial value realized loss by 2040. perhaps, but one of the things that was always curious to me is when I would rent lease a space as small as like our companies have been before, and we'd find this great space and it's been sitting there for 2 years, and we're like, well, hey, give us a discount on the rent, and they wouldn't. And the argument is like we can't do these deals here, and we make more money on another building in another market, say Phoenix, right, or West Coast or what have you. So it was always like the commercial real estate is diversified enough in these larger office buildings where they have multiple markets. Well, what happens if all the markets are having the same issue, right? And that's never happened before. And so I think it's a potential problem. And and I'm not sure the impact that's going to have. Now, in all things, it's going to shift towards what we saw during the pandemic, because people invested heavily in their existing properties, right? So there are other economies had gain, but where will we really end up being? Kind of feels like we're going to end up just staying in hybrid mode, right, for the most part. But yeah.
Okay, so all that said, Andy, what do you think the single biggest miss by senior management was at SVB?
Model risk management and crisis management. So model risk management meaning where are we putting our deposits and not stress testing it. I think there was one report that talked that their DEI department was almost 10 times bigger than the risk management department. Probably not a good use of resources if you begin looking at what happened. And then the second thing I think would be crisis management. This is clearly and purely that outrun of deposits happened so quickly because the information got out on social media and it spread like wildfire, and everybody reacted and they panicked. Panic kills banks. I remember seeing the CEO of SVB had a quote. He said, no bank could have withstood what they went through. And he's probably absolutely right. No bank could have. The point is, don't get into a situation where you have to withstand what they're going through. And how do you do that? You got to interact and talk to your customers continually. You need to be proactive, not reactive. You got to take the message of your stability to the market, to your customers, to those big deposit holders. You know who they are. You've got a list of them. You probably submit BSA reports on them all the time. And what you need to do is you've got to get a hold of them and talk to them about how you are managing your risk. And you need to take your risk managers, your chief risk officers, your GRC program. You need to put public press releases about those things. You need to make sure that they understand how you are looking at your risk and how you are prepared to withstand what's coming, because there is some additional ripple effect still coming.
Sure. Justin, anything to add?
I think it's well said. I would just say that interest rates wasn't overnight. Wasn't like, and a European market just failed and we had to respond to that. They could have seen that coming a long time away and could have prepared that communication a lot better. I don't think there's anything we can all do to avoid a situation like a bank run, or who was it, GameStop, right? Look at all the power of these networks that can drive behavioral changes, right, and change something positive or negatively. I don't think we can avoid that, but definitely think that could have been handled better in terms of communication for sure.
So while many consumers have flocked to mega banks like Chase or Wells Fargo amidst the recent bank collapses, many higher risk markets aren't able to follow suit. So how can community financial institutions work with these markets in their communities?
We do that every day. I'll jump in there and then hand it over to Andy. So funny we say higher risk, right? I just want to address that term for a second. That definitely, there are markets and business types that have higher risk than a typical business or consumer. However, that is a bit in not just in the regs and the CDD to EDD that you do, but it's also in understanding and having the right tools, right? So as an example, if you have a very manual program at your institution and you have an MSB and they were very difficult because it was all very manual, then definitely higher risk because you've got a lot of things to do. But when you think about using technology that can turn your annual review process into quarterly review, and you can collect all this additional information on them and monitor them to their business type, it really reduces a lot of that risk. I still consider it higher risk, but I think people have a different perspective in the banking space, given the sort of legacy financial crime, software that's out there. My suggestion is, look, cannabis is not for everybody. Online gaming is not for everybody. We've seen some massive portfolios in both. but they're not for everybody. So look at your space, look at what you can do in your community. I'll give you a perfect example. Hemp is different than cannabis. My family are fourth generation farmers. My dad's moving back and retiring to the farm. He wants to use our farm and our equipment. He wants to grow hemp. His bank of 40 years is going to kick him out. He's a very entrepreneurial guy, and he's capable of doing a lot, and he could grow some really great industrial hemp that could lead to, we're building houses in Austin now with industrial hemp, could lead to a lot of amazing things. But if you throw that baby out with the bathwater as an institution and say, well, hemp is cannabis, and so we're not going to do it, not recognizing that Texas is one of the most strictest states in that regard, and we have 3,000 hemp license businesses here. So, and then our agriculture commissioner supports that. So I think when you look at it, you need to consider, really the devil's in the details. What is my organization capable of doing? What do we want to look at market-wise? Really understand those markets, and then start partnering with people who can give you great advisory services, so can tell you what the compliance requirements are going to be, who understand those, and then use technology to automate it. Right? If you opened up a, let's just be ridiculous, 7.5% interest account right now, any of your institutions that are on the call, right? If you did that right now, you're going to have hundreds of thousands of people applying, no doubt, right? Forget the economics on it, but you're going to have this volume you can't handle. You don't have technology to be able to board those customers, and you're probably going to fall over, right? So to me, that's the same sort of situation with higher risk, is looking at it like, these are markets that are in my backyard. What am I comfortable with? What is our organization comfortable with? How do we build a plan? And then how do we use technology to automate it?
Yeah. Andy, anything to add there?
I think my experience in dealing with the big banks is that you're a number on a spreadsheet, and they treat you like any other business with like your similar profile. And when they say profile, they just mean revenues and expenses, and that's it. And so when I started Quantivate, I tried to work with credit unions, tried to work with big banks, and they didn't understand the software as a service business. They literally treated us like, well, what kind of assets do you have? And you're like, I have no assets. And they go, well, therefore you have no loan, right? They didn't realize the risk we were taking, what we were building, the value we had in customer goodwill, recurring revenue businesses. They had no idea with it. Until 15 years in the journey, we found a bank that actually built a business model around that. What can you do as a small community financial institution? Well, I mean, there's technology is one solution. I agree, Justin, that's very important. Technology guy, I'm here. But the other piece about this is you have feet on the street, and you can make relationships with actual businesses and real people and understand the business better than any big, huge financial institution can. They're just a number. They're a model. They're going to put them through. They're going to spit out the same interaction with that particular institution or organization. You have feet on the street. You can get to know them. You can get to understand what they're doing, get to understand their business plan. You can spend a little bit more time, a little bit more relationship, and that will pay off for years and years to come as you begin to understand the emerging businesses that are coming forward. And there's going to be a ton of them. And so new markets, new ways of doing things, be early, be an adopter of understanding those types of businesses, and I think you can come out a winner.
Yeah, just one quick thing, Kristen, that during this whole financial crisis SVB, our VCs called us and said, we want you to get out of SVB, a tiny SVB account under the FDIC limit. We were not concerned. In fact, I remember telling them on that Tuesday, we're not concerned. A, we have FDIC insurance, but B, this isn't something unless you make it something. And then by Friday, they made it something, right? Not just our VC, but all the VCs. But we tried to go open an account on Chase. And I actually documented this on my LinkedIn if you want to read it. And it was the most horrendous process ever. And they were just literally like, you don't like it, sorry, whatever, right? Just go on to another bank. And so that's just evident of all the kind of treatment you're going to have. Even with, and I mean, we're a business that's got funding with a 7-figure account, but they don't care, right? So, and they would not be the ones to give us any type of loan or line of credit. So, yeah, we've had practical experience with Chase in that regard.
Yeah, and I would just add my 2 cents for 1 second here, which is you gotta know who's in your backyard. There's businesses all over you're in your own backyard that are seeking out financial services that just can't find a place to serve them, so they go to these big guys and they go in under the guise of somebody else just to try to get by, to get something so they can run their business. So I really, really encourage people to really understand who's in their backyard, because we talk to CEOs all the time and bank employees who say, I was to say, do you know who's in your backyard? Do you know that you have 1,200 of these licenses in your backyard? And they say, no, we don't. And that's just not being a good community financial institution, right? And you're not even taking advantage of the opportunities that are in your own backyard. So, I mean, I know I'm not a CEO here, but I'm telling you, I've also slept at a Holiday Inn Express before, so I know a little bit on that regard. So let's do one more question here, and then let's go on.
Holiday Inn. What's the matter? Why would everybody hate Holiday Inn so much? I always thought they were great.
Let's do one more here, and then we'll go on to the prep part. So let's go with the question that came in right before we started on the higher risk stuff, which is how do you respond to customer concerns regarding the solvency of banks amidst bank failures? Andy, I think you should take this one since you've been part of.
Yeah, sounds good. I've been in a bank prior to them failing. I didn't go through it while they failed, but then I also understand the fallout of the SVB personally because we were at a different institution. And I think they did a fairly decent job with us, meaning they were proactive with us. They had very good communication. They not only relied on digital communication and sending out that information, but they also followed up with personal phone calls. And again, if you look at your book of business, you look at your deposits, and you understand those top 20% are going to be 80% of your deposits, the 80-20 rule, spend some personal time on those 20% and interact with them, get to know them, understand a little bit about their business, understand their fears. And then the other part about it is help them manage their risks, right? What are their risks? Hey, I can't make payroll if all of a sudden you guys shut down. And my employees have to get paid, otherwise they lose their house, right? That's a big fear of the CEOs making payroll. You're going to make payroll, right? And so that's a huge issue that they've got. And then, maybe they put capital there and they wait for the right time to spend it. And then how do they know it's secure to be there when they need it? So these are great questions. Also, work with them, and I think our bank did a good job of this, of saying, look, we understand that you have concentration risk also, so do we as an institution. And maybe what you need to do is you need to have deposits in a couple different institutions so that you feel your concentration risk is appropriately spread. Help them do that. Give them a plan to do that, but make it proactive so that you can manage it with them rather than waiting for them to freak out and yank everything the same day when social media spreads it. So, if you take a proactive approach, you're human with them, and then you give them a way to manage their concentration risk, I think you can be much better off than just letting it ride and kind of rolling the dice.
Yeah. Any final words there, Justin?
No, it's well said. I mean, I think I said it earlier, but the primary reason for most of the deposit exiting was a lack of understanding of FDIC insurance and how to use sweeps and transfer tools that most institutions already have access to. So I think that's a communication issue for sure.
Yeah, absolutely. All right, my friend Ethan, how about we do another poll?
Absolutely. Y'all will see our third poll coming up on the screen today, and that is asking, how confident are you that your financial institution is well prepared to handle the surprises the next 18 months may hold? Quick response here, you're either extremely confident, moderately confident, somewhat confident, or the dreaded not at all confident. Y'all will take a quick second and go ahead and tell us how you're feeling about those next 18 months before we dive deep into how to prepare for them. Give y'all just a couple more seconds here.
I feel like we should be playing Jeopardy music in the background.
Alrighty, so you guys should see the results popping up on your screen here. Fortunately, looks like the majority of our audience is either extremely confident or moderately confident, with that coming to just shy of 80%. A quarter of our audience today is only feeling somewhat confident. Thank goodness, 0% are not at all confident, which is excellent. I'm curious, Justin, how does this stack up to what you hear when you speak to financial institutions?
I think, let's see. I think number one, the majority of community financial institutions that I've seen, let's put it this way, had a plan for 23 and 22, and then have changed that plan a bit in terms of spend. I mean, I think American Banker did a research recently around March or April when all this was going on, and they found a like 12 to 15% additional spend in risk and compliance management as an example. But I think the thing for me that's not surprising about this is I think it's kind of like, well, we weathered the pandemic, so, you know, bring it on, right? And so I think there's a confidence that comes from that. And I don't think that's misplaced. I also think, you know, likely a lot of the people we have on the call are coming from BSA and risk management. And, you know, let's face it, we're used to doing more with less and we're used to surprises, you know, and so I think for the most part, that's what drives the, you know, are you prepared, which is, you know, Kristen says it well sometimes. I've seen it all, right? We say that sometimes if you use another colloquial public thing, the farmers commercial. We've seen a lot of things in compliance and risk. So yeah, it's not necessarily going to surprise me. That's where I think maybe the mentality's at.
Anything to add, Andy?
You know, I would say fear, uncertainty, and doubt is a risk manager's friend. And I think you need to have a healthy skepticism and pessimism around anybody who says they're extremely confident in your bank to be able to survive. And my reason for that is, you know, everybody believes that it's all good based on what we've seen, and nobody thinks that a quote unquote black swan event can happen. But I think we've seen black swan events occur like twice in the last 5 years. Right? So are they so black swan when all of a sudden they keep occurring? And so trust but verify, meaning what controls you have in place, how can you test those controls, and then what sort of contingency plans you have in place when things go wrong. It's not if things are going to go wrong, it's when things are going to go wrong. Take that mentality, take that skepticism and work it through the culture of your institution. And in some ways that flies in the face of being able to grow an organization quickly and be nimble. But on the other hand, I think that you have to be the governor. You have to also be the conscience of an organization as you begin looking at risks to help kind of assess truly what could potentially happen in the future. So yeah, that would be on my only point. I bet you if you gave that maybe that same question to CEOs, and they were being honest, not just publicly facing. Deep down, a lot of us don't sleep easy at night thinking about all the potentials that could go wrong. So not everybody is extremely as confident personally as you might be publicly, because again, uncertainty is a killer business.
Well, you don't know what you don't know, right? So that's always the biggest pain point. I always try to teach the people that we work with and understand, or help my people even think through what's the worst that could happen here. And yeah, you got to plan for it. And sometimes, you know, things just slap you on the face like a pandemic where you're just all of a sudden you were completely a cheeks in the seats company, and now all of a sudden in 2 weeks you had to send everybody home, right, to work from home. So there's all these different things. You can only try to prepare so much, but now that we have seen what we've seen, we know that we can't just live by the contingency planning of, well, she's never going to leave, so we're just going to keep business as usual, right? It's a vicious cycle. So on that note, so let's switch gears a little bit. How do you see the development of AI impacting the tools and technology that FIs are leveraging today?
That's a fun one. I've been doing a lot of research on machine learning and artificial intelligence, and you know, when I first started in compliance, I would go to ACAMS, and we go often anyways, but go to ACAMS, go to compliance conferences, and you know, first thing I'm going to say is I think if you're in BSA and risk management, you got to be super careful you're not getting overhyped. And I'm sure we're all familiar with those vendors. I use the V word. We like to say we're a partner because we are a partner. We're not a vendor. But you know, those vendors who are trying to sell you something because it sounds great, right? And I mean, you know, some automated virtual human who's supposed to do all my work. Okay, right. I will just tell you at Q2, we built some of the original risk models in 2011, 2012, and they're still being trained today. So, you know, it's not something that is, you know, instantly solving some of your challenges. However, what I'm excited about with machine learning specifically is taking a lot of the mundane tasks and known patterns and then new and emerging patterns and being able to get someone like Kristen or a career BSA officer to respond and help train those things, because I think it can take a lot of load off for those kind of common things. And then I'm equally excited about generative AI, which is like the technology behind ChatGPT, for example, that can take large unwieldy text like regulator reports and C&Ds and the exam manual, and can basically consolidate that into a more chat-like interface. So what's the reg around e-statements, what's this, what's that, and being able to parse through that information and sort of be a co-pilot. So for me, those are the two things I think that are going to be the most interesting things that come out, is sort of fraud and transaction monitoring ML, and then generative AI that can really help you as a BSA officer get answers that you need to. And then when you can't, being able to reach someone who's qualified to help from there. But that's my thought.
Andy, how do you think, how have you seen this from a GRC impact?
Yeah, it's going to be disruptive, but I think it's going to take longer than people think for it to be as disruptive in the GRC space, primarily because what you're trying to do in risk management is assess risks that maybe haven't actualized yet. And that means that the patterns aren't there for the AI to ingest. So maybe there's going to be a generative AI that can produce those sort of risk analysis, Monte Carlo analysis with made up data going out into the future. But again, that's the challenge. And so the human element is always going to be required. Can it make your job easier? Can you, for example, write a policy a lot quicker? Just ask the AI to come up with an example policy. Absolutely. But every policy, and we all know this, and every control, it's only as good as the people that are supposed to know it and implement it. And so those are some of the challenges, right? Some of the biggest fraud events and theft events of data have just simply occurred of somebody forgetting, right, to put a patch in, or being taken advantage of because somebody called with a fake voice and they thought it was a real actual customer or something, to give them a password. Those are some examples of the human element that aren't going away. And I think AI will become ubiquitous to us, almost like a calculator is. It's going to help a lot of things in a lot of different ways, but I still think that there's going to be an absolute requirement for human interaction with risk, especially when it comes to financial institutions for the near term.
All right. So I've got 2 more questions for you guys. So we have 8 minutes. So keep it concise as possible. So for the first one, FIs are tightening their budgets in attempts to weather any coming storms. What are some places they should and should not cut down on their spending? Andy, you want to go first?
Yeah. I think that obviously, personally speaking, you can take my RiskScout off. I'm selling GRC software. Definitely don't stop spending in governance. Compliance is going to be another area. You certainly need to understand that regulations are coming fast and furious. SVB collapse has created a lot of concern in the regulator area, and some of those are going to be coming out for the next 5 to 6 years in terms of how they're going to force organizations to look at these risks and manage them. And then the other part about this is just the general uncertainty. I think, at what point, though, do the bubbles start collapsing? In my career, I've seen 2 bubbles specifically, and I've seen a couple minor bubbles. So the dot-com burst, and you're right. I saw the financial collapse. I've seen the crypto collapse. We all have to agree with that. I think we've seen an AI bubble build, and the question is when that's going to pop and how that's going to impact things. This is what we do. This is how our economy is built. It's happened ever since the tulip collapse back in the 1600s, when everybody invested in tulip bulbs at the same time, right? I mean, this is what happens in the economy. So that's the risk manager's job, is to try to help an organization not get too concentrated and don't buy into a bubble. Or if you do, make sure to sell before it pops.
Yeah. Justin?
Safe bets, I think investing in digital tools, automation, and any kind of, good new market that can bring you deposits, low cost deposits, I should say, right? Those are safe bets. Unsafe bets, doubling down on initiatives that aren't working, bigger projects that have stalled, and building branches. You know, I love branches, by the way. I love to interface with my institutions locally, but as a whole, we're trending away from that. So I think, you know, buying branches, deploying branches is probably not the safest bet. Not to mention they've always had a longer ROI, right? So I think those are the two things, or the things I would say.
Yeah. What do we like to say? That you think the cost of compliance is expensive? Think about what non-compliance cost you, right? It's, you know, we're not cost centers necessarily. We are revenue protectors. So on that note, if you had one piece of advice for community-focused banks and credit union executives today, what would it be? Andy?
I'd just say relationships are more important now than ever. The more people that work from home, the more technology we get work with, the more AI comes out, the less interaction people have, the more important relationships become. And so if you focus on that with the customers that are very, very vital to your business and your organization and your success, I think that's going to pay off because you're going to build trust, you're going to build relationships, they're going to come back to you, and they're going to recommend you when the opportunity arises. So the challenging part is how do you get that done in a cost-effective manner? And that's always the biggest challenge that you have when you're in a relationship business. So again, I think understand the business you're in, and you're in the business of people relationships, and invest in that.
Yeah, absolutely. Justin?
I like that a lot. I think it's really important. I would just say take the time to look at your current communities and see if there are others that you could bank, and understand why you may not be banking them. Is that something that, you know, is sort of set in stone? Because I think a lot of times that rarely gets challenged and it's just shut down. And so I think going back and looking at your community and looking at more ways you can bank your community is always a good thing. And that comes from relationships and conversations and understanding these spaces. I just say kind of a sub to that is find a good partner, not a vendor. Find a partner who can help you understand these risks, who can help you with these deployments. I can't tell you lately how I've heard a lot of horror stories of, you know, whether it's a core conversion, digital banking, getting into a new space, using a new vendor. And, you know, you want to trust and believe that they're telling you the right thing, but, you know, check all the references, right? Like talk to good partners who can help you understand if this is the right technology for you. Most institutions don't get out, the employees don't get out a lot outside of the walls. And, you know, people like Andy, me, and Kristen, we've been to not only every conference, but we've also I've worked with every core. I've had interfaces for 90 cores. You know, we've been around. It doesn't have to be us, by the way, but seek that kind of experience to help you really understand what the gotchas are, because good salesperson will try to sell you. And if they do their job, you're sold, right? Then it might be too late. So find good partners as well.
Absolutely. All right. Any other final words?
Appreciate everybody's time. Thanks for having me.
Yeah, absolutely. Well, it looks like that's all the time we have today for this webinar. So I'd like to thank our audience for your time today, and a big thanks to Justin and Andy for sharing their time and expertise today. We will be sending out a follow-up email containing all of today's resources as well as a recording. So be sure to keep an eye on your inbox. If you have any questions that we were not able to answer on today's call, don't worry, we're going to help address them. Excuse me, allergies. One second. I'm so choked up and moved by these guys that I can't help it. But we'll have our experts reach out to you guys this week to ensure you get information you're looking for the many questions we didn't get to answer today. So if you'd like to join us for future sessions, we'd love to have you. So find out more information about us on our websites and drop by to say hi. You can always find us at RiskScout.com and Quantivate.com. Andy, there we go. All right. So thanks again, guys. We really appreciate it. We've had a lot of fun here today, and we look forward to working with you guys and chat with you in the future.
Thanks, guys.